In this video, we'll go back in time to understand how the stock market started and evolved with time to become the centralized trading system in today's world. So, without wasting any time, let's get started. Hundreds of ships were enrolled in the 1600s by the Dutch East India Company to trade gold, spices, silks, and porcelain around the world. This massive operation did not come at a cheap price. Therefore, the company approached the citizens, individuals who could fund the expense of the trips. In return, the investors can expect a share of the profit earned by the company in their journey. This plan of action enabled the company to afford larger tours, expanding profits for both themselves and their investors. The Dutch East India Company unknowingly invented the world's first stock market by selling these shares in distinct areas across the continent. In years to follow, companies started to accumulate funds from willing investors to support their business. The concept of the stock market became familiar to a larger audience with time, and today the stock market has its own educational courses, careers, and even television channels allocated to its analysis. The modern stock market is not as complicated as people portray it to be. To start with, let's understand how do companies and investors use the market today. Let's visualize a new fast food company that decides to take off in the market. First, the company will broadcast itself to a big stack of investors with their ideas, business model, and plan of execution. If the potential investors believe in the concept and ideas plated to them, they get the first crack at investing. Later on, they also sponsor the company's initial public offering, or IPO. Releasing an IPO launches the company onto the official public market, where any investor, be it a company or individual, who believes the company could be profitable in the future may buy a piece of the company, which is also called a stock in today's market. Once the investor has bought a stock, they become a partial owner of the company. The money put in by investors helps the company grow at a faster pace, and as the company earns more profit, more buyers see potential in the company and start buying stocks. As buying demand for the stocks increases, there's also an increase in their price, which in turn increases the value of stocks people already own. Now, turning over and viewing from a company's perspective, the increased interest of individuals helps the company find new initiatives for its growth. It also uplifts its overall market value by showcasing how many people are willing to invest in their idea. However, if you invest in a company, you might not always be profitable. If for some reason a company starts to seem less profitable and investors sense their stock value will decline, they might sell their stocks with the hope of booking a profit before the company loses more value. Stock value continues to fluctuate based on its demand and supply. If the stocks are being sold and demand for the stock goes down, the price of the stock falls. And with it, so does the company's market value. This can leave investors with big losses unless the company starts to look profitable again. This seesaw of supply and demand is impacted by many key factors. Companies are under the unavoidable influence of market forces, such as the varying cost of raw materials, changes in technology used to produce the finished product, and the fluctuating cost of labor. Investors sell or buy stocks with changes in leadership of the company, bad publicity, or factors like new laws and trade policies. All of these factors cause a fluctuation in the market on a day-to-day basis, which in turn makes a company appear more or less profitable to an investor. One of the most crucial factors that makes the market unpredictable is human confidence. It has the power to trigger everything from economic booms to financial crises. For this very same reason, most professional investors promote long-term investing over trying to make quick cash, as it's more reliable and hinders you from trying to time the market. However, investing experts are building systems to increase their probability of success in this highly unpredictable system. One must realize that the stock market is not just for the rich and powerful. With increases in technological advancement every day, investors can buy stocks with a mere click of a button. It's also important to keep in mind that one must educate themselves about this complex system for them to start trading by investing in the businesses they believe in and pursuing their financial goals. The first step is to invest.